Okay, hello everyone. Thank you for joining our last but probably most impactful session of the day. We're going to be talking about what professionals who support seniors need to know about capital gains tax. It's a very important factor for families that oftentimes gets overlooked, especially when families take the do-it-yourself kind of plan and don't really they don't know what they don't know and end up making big, expensive mistakes. So, really excited to have our two panelists today, Eric Brescher from CDEC, 1031 specialist, and Kevin Snyder, who's a very well respected trust and estates attorney. Gentlemen, thank you so much for joining. And uh, we'd love for you to introduce yourselves to the group real quick. Eric, you want to go first?
Sure. Good morning and afternoon. Eric Brescher. I'm with CDEC 1031 Exchange. I am an attorney and hold a certified exchange specialist designation. I assist real estate investors with the deferral of their capital gains and other taxes through Section 1031 of the code.
All
Good
right,
afternoon,
Kevin.
everybody. My name is Kevin Snyder. I'm an estate planning, probate, and estate litigation attorney, and I assist clients on the planning side when it comes to capital gains and making sure that we can maximize step up in basis so that they can avoid tax consequences in subsequent generations.
Sounds good. Well, I have to say that pretty much the whole event was predicated on a story that I heard. Like the whole reason we wanted to do this event, because the big picture of why we're doing this is because we all see things that sometimes just don't make sense. Something's not right. And the idea is that we're all operating in our individual silos, or many times people are in the senior space. We've seen it over and over again, and they may see something that they don't raise a red flag on, and then there's some major implication for the family because they're not communicating between these silos. So the story that I'll tell, just to kind of set the stage here, was someone in Orange County, California, a senior who had bought her home for next to nothing, 50, 60 years prior, solo ager. Um, and she was 97, needed to pay for care, and the family decided, well, she's almost out of money. We need to sell the house. And so that she could move into an assisted living facility, which she didn't even really want to do, but they thought that was really the only option um, because she was 97. So what happened was the horror story for anybody who understands capital gains tax. They sold the home for $4.5 million. And instead of the family getting $4.5 million, they got $3.5 million, and not a bad amount of money that kept in the family. But that $1 million was literally just donated to the IRS, especially with somebody who is 97 years old. So that goes into us talking about the step up in basis and understanding what that is. We are here at this event to try to teach people when to raise a red flag when you see something that doesn't look right. Selling a home right before a senior passes is one of those moments where they might want to say, "Hey, do you have a plan in place for how you're going to deal with this?" So I'm going to call on each of you to kind of talk about different components to it. But Eric, maybe you can talk a little bit about how capital gains tax gets assessed. I know it's different for primary residence versus investment property. And then if you could kind of define for the group what the step up in basis means.
Yeah, sure. Well, so as you say, I mean, look, capital gain tax is a function of gain, right, over the basis. So when we talk about basis, we some people call it cost basis, adjusted basis. But what we're talking about is what a taxpayer paid for the real estate, plus we add any capital improvements to increase that basis. And for investment property that's improved property, we also have a depreciation component. And depreciation takes into account the useful life of an asset. We won't bore everybody with all the depreciation, but it is a beneficial phantom expense, accounting expense that offsets rental income. Now, you may have investment property that's raw land. Again, that doesn't have improvements. So we're strictly talking appreciation. But basically, you want to determine what the realized gain is in the property, which again, what you paid plus any capital improvements, less any depreciation. And when you subtract that from the sales price, that is a realized gain. Now, with investment property, Section 1031 of the tax code allows you to defer that gain and not recognize that gain. And that's really the real benefit, that you can defer that gain and leverage what you otherwise would have paid in tax into new investment property, which number one helps retain your net worth. You didn't lose, as you talked about, donating unnecessarily to the government. And of course, ultimately, when the taxpayer passes, the heirs will get a stepped up tax basis. So, what do we mean by that? That's Section 1014 of the code. And that states that, and we won't get into all the assets, but we're only concerned with real estate. The idea is that the heirs will inherit that property with a new basis, which is the fair market value at the time that the taxpayer passed. So that same step up in basis occurs on a primary residence. So to your example there, very unfortunate situation. Taxpayer there would have been much better off maybe coming to you, refinancing the property, pulling out, they didn't have to pull 80% out of their equity, but something, $1 million to get them through the next few years, to pay the carrying cost, to pay for, assisted living or whatever, if that was necessary. But that would have been a much better strategy. And then, of course, ultimately, when the taxpayer passed, the heirs would have inherited it with, maybe it would have continued to appreciate if they, the taxpayer lived another 5 years, right? So that would have been a much better strategy there. And again, that regularly is done with 1031 exchanges. But again, that's only for investment property, which I think we'll talk about a little bit later.
Right. And the context of that story was that there was a placement advisor involved. Obviously, there was a real estate agent involved in the transaction, but to our knowledge, nobody either knew what the tax code was or advised the family. They weren't getting proper advice from, I mean, if they would
Very
have come to any
unfortunate.
one of three of us, we would have said, wait a second, don't do that.
Right. Time out.
Right. So they weren't getting proper financial advice. That's like a big picture thing for me is don't shortchange on the professionals who can support you and keep you from making big, expensive mistakes. But the idea is, again, the whole big picture of this event is to arm people with the knowledge to know when to raise a red flag, to say, hey, I don't do this. This is not part of what I do, but I think you may want to talk to an accountant or an estate attorney or Eric, at CDEC or whatever it is, just someone who can say, hey, what you're about to do may not make sense for you to do. It's so impactful. I mean, that's somewhat of a mildly extreme example, only because the person was in their late 90s and, maybe they lived another few years. But that's a failure of communication and knowledge. And we'll give everyone the benefit of the doubt, of course. We just assume that they didn't know. We hope that it wasn't a situation where maybe the real estate agent knew but didn't say anything because they wanted to sell the house. Again, we're giving everybody the benefit of the doubt of being a professional, but that's where we need to raise the bar. That's why we're here at this event, is that we want people to understand how this works, so that they can call out that type of situation when they see something like that, whether it's a placement advisor or a real estate agent or anybody else, a friend of a family member, who now, hopefully, if they've, watched this session, by the time we end it, they'll know that selling a house right before you pass is probably not going to be your best move. So Kevin, have you come across any situations where, a family came to you and they were thinking about doing something and, the capital gains tax just wasn't a consideration in their minds, but maybe they changed gears to to do something different because of that implication?
Yes, I can think I have a really good example. I practice in Orange County, so this is going to be another Orange County
There we
example. I
go.
mean, we're statewide, but our main office is in Orange County, and this was a number of years ago. But a client had an inherited property on Balboa Island. It was multifamily. Balboa Peninsula was multifamily, and the parents of my clients actually built the multifamily dwelling originally. They were the original owners, and they passed it down to their son, and so they then, of course, had they did that correctly at death, so there was a step up in basis. And then the son had it for many years, had daughters of his own, and when the daughters became adults and responsible and professionals, him and his wife gave them each a quarter of the property. So now they co-owned the property, half of it with the parents, half of it with the adult children, and that's when they came to me for the first time for the estate planning, and I'm doing the fact finding, and I find out about this property, and then I explained to them about how that they had just basically created a big taxable event for their daughters down the road. This was not going to be a property that they were going to ever sell in their minds. It was family property. It was good passive income in a super appreciating area. So they, did the math for them, and they were shocked that they thought that this was a good idea to kind of co-own this together as joint tenants, avoid probate. We weren't contemplating the capital gains tax problem, because when they died, then only half of the property was going to get a step up in basis, and we're talking appreciation in the millions at this point in this juncture. It's an $8 million property, at least as of a couple of years ago when we had it appraised. And so this was a real issue, and we had to undo what had been done in the sense that the daughters had to gift back their 25% each. And we unwound it all. So now the parents owned it, and the husband has since passed away, so it got another step up. And but again, it doesn't appear that they're going to sell it. But my guess and my hunch is mom and dad enjoyed the passive income, and they were managing the property themselves. The daughters live out of town. One lives in the East Coast, and so the reality, they can say everything that they want. Oh, the girls are going to get this wonderful passive income. The reality is that the adult daughters are probably going to sell the property, and so fortunately we were able to catch that in enough time so that they weren't unhappily surprised later. At least the girls weren't.
Yeah. Yeah, it's a perfect example because as parents, you think you're doing something good for your kids, and basically you're
Mhm.
handing them a tax bill.
That's right.
Even though it's, I'm sure, beautiful property, and maybe they gain more than they lose, but still, just the planning of how to do that is impactful. It's kind of like when you win a car on The Price is Right, and then you get taxed for the winnings of your car.
That's
It's like,
right.
wait a second, wasn't I
Right.
just supposed to get a car? No, you got a car and a tax bill for the value of the car.
Mm.
Um, so and Eric, I don't know if you want to speak to this, but when someone sells a primary residence, there's also a certain amount of gains that you can have before it actually becomes taxable. Are you familiar with those
Yeah,
rules?
so section 121 of the tax code allows for a single person the first 250,000 of gain to be excluded, and a married couple the first 500,000 married to file jointly to be excluded from their tax. So obviously, to your point earlier, one of the first things is that hopefully they have tax professionals around them, first and foremost the CPA. And therefore, that would be the appropriate person to start the conversations with around, hey, if I sell this, do I have a tax? What's it going to look like? I mean, that's the kind of conversation you have to start with. And obviously, especially with investment property, there are occasions people may have carried forward losses. There could always be reasons not to do an exchange, or where they don't qualify to do an exchange. But without having the communication as the starting point, you're just coming out of the gate wrong to begin with. But so to the extent, and I can share a quick example, I handled an exchange several years ago, which was pretty extreme in that They bought it was a Northern California property. They had owned it for 20 years. They paid $1 million. It was their primary residence. They moved out of it for many years because it was worth $15 million. So they moved out, they rented it out, and their CPA felt it was sufficient amount of time to have abandoned their primary use, to treat it as an investment property, and they deferred it through Section 1031. So it's something to think about if you have highly appreciated a primary residence, to consider moving out of it, renting it out. Again, if there's maybe a shorter term situation, like we said earlier, maybe refinance the property to pull some equity out, assuming there is some. Those are, situations where taxpayer is going to be, well ahead of the game relative to just selling, before passing.
Right. And oftentimes what we find, especially with seniors, they think, okay, I need money. Maybe they're not tremendously affluent. They need money to pay for care. I have an asset, a home. I sell the asset to pay for the care that I need, right? It's kind of like a normal trajectory of thought. But there's so much more to it. And what you were referring to, Eric, was exactly what I spoke about on in one of the first sessions earlier today about creative financing for seniors, and talking about when you need to raise capital, there's three options. You could sell the home, and you have all the tax implications potentially. You could rent the home, or you could finance the home, and the combination of renting and financing gives you the capital you need while still avoiding the capital gains tax potentially. Um,
And
you
just
put
to throw out there also, when we talk about primary residences, there's obviously the difference between a single family where it's just owner occupied and maybe a two family. Or I know obviously many people have converted garages into ADUs and rented that out. And so understand that even with a primary residence, if there's an investment component, because it's, let's make it simple, a two family, 50% used by the owner, 50% rented out, we can bifurcate that sale, and they can utilize the Section 121 exclusion for the primary component and utilize the 1031 exchange for the investment piece. So, again, you have to ask the questions, understand what we're dealing with to see, which bucket we're going to deal with. And of course, again, you can get creative, and if you have the time to do that, to make it fit into one box or the other.
Yeah, and also because the audience for this event is national, we also have people who are in, we're Eric, I know you're in New York City. Kevin, you're in California. We're physically located in higher priced markets where these things are more impactful. Sometimes you'll have homes in a certain area that the predominant value of homes is, $500,000 or less. So this is less impactful the lower the prices are to sell, and let's say an average home. So if you're selling your home for $300,000, the likelihood that you're going to have some significant capital gains tax is obviously pretty minimal. But as you get into
Mark,
higher price markets, it's more impactful.
yeah. And, we're talking primary residence, which of course is the typical real estate asset that individuals have, hopefully. But there are applications for 1031 exchanges. I know we're going to get into it a little bit more, for second homes and vacation homes. So, people need to be thinking about that as well as they're getting older, and maybe, rather than, there might be a change in need, but rather than just sell it and pay tax, understand the applications around 1031 exchanges for that specific asset where there may be some applicability.
Yeah, absolutely. Okay, so let's get into some of that detail. Now that we've kind of covered the step up in basis and what price ranges maybe are impacted by this. We've talked a little bit about the strategy of maybe not selling your primary residence, keeping it as a rental property. So let's talk, Eric, about how a 1031 works, just kind of nuts and bolts for the audience, just so they have a general sense of what it is, how it works, and then some of the benefits of doing it.
Yeah, sure. So, I want to just kind of clear up a misconception around these, because unfortunately, from time to time, and more than I'd like to hear, I hear 1031 exchanges referred to as a loophole. It is absolutely not a loophole. There's nothing ambiguous about the code. There's nothing omitted from that code. It is designed to do exactly what it was intended to do. And it's been around since 1921, albeit a different section at the time. But it's a methodology for, and without getting into the changes in some of the tax code, but people, it was pretty recent back in 2018 that the Tax Cuts and Jobs Act went into effect, and it limited 1031 exchanges only for real estate, because you used to be able to do it with cattle, aircraft, artwork, other things. It is now only available for real estate. And so it allows investors essentially to just continue their investment. No different than when you have a 401k and you buy and sell stock, but you sell it, you buy something else stock wise. It allows you to grow that portfolio. So that is what 1031 exchanges are doing, but only for real estate. And so you have to have investment property. There has to be this notion of an exchange. Again, that property has to be held for investment or used in a trade or business. And then, you may hear this term like kind. I will just get ahead of it by saying with real estate, all real property is like kind to all other real estate. So the whole
And the like
purpose,
kind rule, Eric, is that you have to sell something similar. Like you can't sell real estate and then invest in stocks, for example.
that's right. That's right. So, when it, with artwork, maybe you had to sell a statue and buy another statue, right? You had to look at the North American Industrial Classification System to determine if it was like kind. But with real estate, it's very flexible. Essentially, all real estate is like kind to all other real estate. And I won't get into some of the state rules, et cetera. But again, the whole idea we talked about earlier about adjusted basis, and we didn't really flesh out all of it because it was just capital gains that was referenced. And then I just brought in the concept of depreciation earlier. But so you have at a top rate of 20% federal capital gains tax for assets that are held greater than a year. I mentioned that depreciation, which creates a accounting expense for the useful life of that asset against the rental income. So it's a great offset. And, on a after tax basis, people put more money in their pocket because of that offset. However, that depreciation amount over whatever the ownership history is gets recaptured. And that's called depreciation recapture, which is a 25% rate. Of course, most states have a state income tax, and I know where the two of you are sitting. You got the dubious honor of north of 13%. So that's a state income tax issue. And lastly, the net investment income tax of 3.8%. So a lot of taxes, right? So we typically call it roughly 35%. Which again is unnecessary to pay if you structure the transaction and the sale as an exchange before escrow closes or title passes to a new buyer. So
Right.
that's
So
sort of,
if you're fortunate to pay the sunshine tax, right? That's what I refer to it as. Living in California where you've got some extra taxes that you might not have if the property was in other states, you gain $1 million over the course of 10 years on a property, you could lose $350,000 of that if you just sell it and cash out,
that's right. And so
right?
again, 1031 exchange is very powerful wealth preservation tool.
Right.
But I know obviously the spirit of what we want to also address here is, some of the strategies, and particularly for older individuals that either are thinking ahead from a trust and estate perspective for their heirs. Again, the 1031, a lot of misconceptions. People think I'm selling a single family, I have to buy just one other single family. That again is not the case. Like kind, you can buy any type of asset class. You actually can buy geographically anywhere in the United States if you're selling United States property. I'll spare us talking about foreign property, but you also can, again, diversify anywhere state-wise, anywhere asset class-wise, and by number of assets. So if an individual has 2 children, they're geographically diverse, you have the ability to take control, sell the asset in advance, and roll it into two assets, maybe one on the East Coast, one on the West Coast for your two kids. And
Right.
similarly, there are a lot of passive strategies. So could be depending on the size of the transaction, could be net lease property. You think about a Burger King or a Starbucks or a CVS where you have a long-term lease with a credit tenant, no obligations from in a true triple net for the owner and the tenant. You just collect a check in the mail every month. And what has also grown as a tremendous strategy for 1031 exchange clients are Delaware statutory trusts. And those are institutional grade properties, could be $100 million apartment complex, or I just had something come across my desk. It's a Tesla property is the tenant. So lots of interesting things where, even if it is a $700,000 sale, you can put that money to work in a passive investment where you'll get, let's just pick a round number, 5% return, and the taxpayer does not have any management responsibility. So again, you may have a significant other, the wife, the husband, whoever it is, that is not going to be in a position to manage that 10-unit apartment building that they've owned for the last 20 years. It's an opportunity to get ahead of things and put it into some passive property, or there are a variety of strategies where somebody may have accumulated a number of assets through the course of their life and they want to roll it together to create some more efficiencies. So those are some of the high level strategies that people often do. And again, the whole spirit is that you are going to defer, you're not avoiding, you are deferring that capital gains tax and the other taxes that we mentioned.
Right. So as we apply this to seniors getting older, they're living in their primary residence. Maybe they need to move into assisted living, for example. They're debating, should I sell this house? And they're talking to an agent, and maybe the agent thinks it's a good time to sell, bad time to sell, whatever it may be. The idea is that someone should call out the fact that, hey, you may want to look at what the capital gains tax implications might be, because it might make sense to just buy time. Basically, that's what you're trying to do. And maybe more so with the step up in basis. You're trying to buy time so that maybe you sell it after the senior passes. But one of the worst times probably to sell that home would be as the senior is getting into their final days. I actually had is another inspiration for this session. I had a client in New York who the gentleman was trying to avoid probate, Kevin, because he hadn't properly planned and set up a trust, but literally in his last hours of life at a closing table trying to sell the house so that his kids would get the money and it wouldn't get caught up for 6 to 12 months because he hadn't done proper financial plan. And the poor guy almost died at the closing. It was that bad. I'll spare you the details, but it was clean up on aisle 4. It was not a good thing. But these situations happen, and it's just one of those things where maybe collectively we can raise a flag to say, hey, I know you're calling somebody about selling the home, but have you thought about this other solution? And maybe it's not that you don't ever sell the home, but maybe right then and there is not the time to sell it. And then when it comes to the 1031 exchange, is a question for you, Eric, and Kevin, if you have insight on this as well. If you do a 1031 exchange and then the senior passes away, do the heirs, the kids, let's just say, get to take advantage of the step up in basis where they might be able to sell that property after the senior passes and avoid the capital gains tax hit that they would have had otherwise?
Absolutely. I mean, in the same way with their other assets, whether it was a primary, whether it was an investment, whether it's stocks, I mean, there is a step, without getting into like retirement accounts or a different issue with the step up. But yes, the idea is absolutely the heirs would inherit it with that stepped up tax basis, which would be the fair market value at the time of the passing. So
Right.
that would
And
certainly
I've
be
heard
something.
that, again, this is not my area of expertise, but one of the best things you can do is when the senior passes is to do a date of death appraisal on that property. So you have a documentation to show what the property was worth as of
That's
around
right.
that date. Obviously, it's
Yeah.
not on the exact date necessarily, but somebody sometime around then.
Yes, that's right.
Yeah. Okay. Well, okay. So, Eric, thank you so much. That was super helpful. It just, again, we're not saying that it's the right decision for every family to rent a property rather than sell it, or to wait for the step up in basis, or to do a 1031. But it's one of those things where if you know a senior is about to sell a home and you know that they, have lived there for 20, 30 years, in all likelihood, that house worth a lot more than what they paid for it, right? If you're in anywhere near the areas where all the three of us are, any house you bought 20 years ago has got some serious tax basis built into it at that time. So the idea is to call that out. But I would love to, Kevin, sorry, I didn't mean to leave you on the sidelines that long, but there's a lot to
No,
cover.
all good.
But I want to talk about some of the more trust and estate strategies that can mitigate capital gains taxes as well. So, one question that always comes up, and it may sound like a ridiculous question, but we get asked it a lot, is if someone is exempt from paying capital gains tax just because they have a property in a trust.
Uh, that's not an outlandish question because the concept of a trust outside of perhaps a practicing attorney, if you're not used accustomed to doing that, trust sounds like it has a lot of different qualities. A very close cousin to that question is I have my house in my revocable trust. Aren't I immune from lawsuits? So those kind of go hand in hand. The answer to the question is you're not immune to either. So but it's seen as a pass-through entity, just like a single member LLC. So as far as the tax, the IRS is concerned, it's just as if the individual is owning the property. So there's good news to that though, because if you have your home in a revocable trust, then that and you pass away, then there'll be a step up in basis on that property for your beneficiaries. So that's exactly what we want to do. And of course, the trust helps avoid a probate process. And depending on what state you live in, that it can be largely helpful. In California, for certain, we have a very antiquated, a long, lengthy probate process. Other states, it's not as much of an impact, but anytime you can stay out of court, or whether it's a short process or a long process, and just do the transition of assets in a law office or any office, then it's a good thing. So having a property or appreciating assets in a revocable trust is treated as the same as you owning them still for tax purposes. You get the step up in basis at death. If you sell your property, then all the things that Eric just said are the same benefits, and with the tax code apply. So if it's your primary residence, the Section 121 exclusion works. If it's your primary residence, if you're selling it from your revocable trust, they're going to pass through the trust and then look at who the current beneficiaries of that trust are. And if it's your revocable trust, that's you. So if you're single, you get the 250,000. If you're married, you get the 500,000, like Eric said. So you still get the benefits of the tax code, but you would still have to pay capital gains taxes in the situation. Let's say you have a primary residence, as Eric was mentioning. Hey, there's $15 million primary residence. It appreciated a ton. Your 500,000 is going to be a drop in the bucket. You're still going to have to pay capital gains taxes if you sell your house, whether you own it yourself or you own it in your revocable trust. So the trust itself, does not, the concept of the trust doesn't prevent capital gains from being owed. However, there are some strategies utilizing trusts that we can look at to try to do a technique that we call step up in basis harvesting. So that's different. That is utilizing special terms within a trust. So it has to be basically a special trust. So your typical revocable living trust that many people have, and whether they're single or they're married, they set it up during their lifetime. They can change it during their lifetime. any amount of amendments that they want. They can revoke it entirely. That's a revocable trust. That type of trust is what we were just talking about. All the same tax codes apply, just as if it was you owning it. The other type of a trust that we can look at utilizing in the scope of capital gains tax planning is an irrevocable trust or irrevocable trust, depending on if you're a potato person. We hear both sides. I say both sides, depending on what mood I'm in. But that's the converse of a revocable trust. So there cannot be changes to that trust once it is established. So the rules are set, and the rules say a variety of different things. Assets might be able to change within the trust. There could be change built in as a rule, but the rules cannot be amended. The rules are fixed. They're set in stone. So that type of a trust affords us some strategic advantages when we're looking at trying to maximize the step up in basis on properties. I'll give you an example of where this might be helpful. And seniors play into this particular strategy, but in a different sense than what you're bringing up, Mark, as far as, well, it's the senior's property. And we've been talking about that today with that in mind. It's the senior's property. Here, it's not the senior's property, but it's a good example would be a successful adult child who has real estate that, or any appreciable asset, but because we've been talking about 1031 exchanges, we'll just continue to focus on real estate. That property is very valuable. There's a low basis that the adult child bought that house 20 years ago. You know, mom and dad are in their 80s. Their kids might be in 40s, 50s, sometimes 60s, depending on when they first started having children. And their children have real estate that has appreciated quite a bit. One technique that we use is for those clients, the adult children, we can establish an irrevocable trust, and we can make their parents the beneficiary of that trust, in either solely or in part. And so it could be that the children or their children are beneficiaries, but we put in their parent or parents that are still alive, and give those parents what's called a power of appointment. It's just think about a special language that's in there that conceptually the parents could, on their in their will, on their deathbed, assign their beneficial interest to anybody in the world. They're not going to do that. That's not the protocol, but that language allows a step up in basis to occur, because that's how the rules work. So we use seniors sometimes from that situation because of the life expectancy. Now, of course, in the situation, let's say the child predeceases the parents by happenstance, there's still a step up in basis in the property to the beneficiaries after death. So it's a way to take a appreciable piece of real estate, and it's got low cost basis, which means it's now the market value is a lot higher than what you purchased it for. And then we nest it in an irrevocable trust. So no matter what happens, the parents died, adult children die, that property is going to experience a step up in basis. Now, you know, the parents in that equation and the children are hoping that it's not the adult children that pass away first. But like I said, even if that happened, there's no adverse consequence. And that is a strategy that it's been available for a long time, and it's just not used quite as often out there in the marketplace. But it's something that we take a look at. The other part of that for the senior even is an irrevocable trust that has something called a swapping power, meaning that we can pull assets in and out of that trust that's set in stone. And we can take, if you have created a trust, an irrevocable trust, and you've put it into that a piece of property that later it hasn't really you have a property in there, but on the outside you have outside of the trust you have a property that has appreciated greatly. The property inside the trust really hasn't appreciated that much, but you have property on the outside that has. You can switch the assets, and I'm going to put my highly appreciated property inside this irrevocable trust, so that when I pass away, or another person, like we use the step up harvesting strategy, when there's a death of the person that created the trust, that high appreciating asset is now achieving a step up in basis. Because sometimes we make investments in real estate, some work out really well, some don't, right? And so this provides some flexibility for people to say, hey, the step up in basis, comparatively speaking, it would be much better if we had this asset in here than that one. And then so they can go ahead and do that. So that's an example of how the set in
Seems like
stone.
rigging the system.
Well, as Eric said, it's not a loophole or rigging the system. These are things
Right.
that
That's the rule.
that were established in the code, and they're laws that are very clear. We're following what the letter of the law says you're able to do in there. So until there's another law that says you can't do that anymore, or if they've amended it, that is the law. And so it is something that we can take advantage of and be creative with the laws themselves. And there are plenty of opinion letters out there now. Opinion letters are just when the IRS gets an issue in front of them and writes an opinion. So somebody might write to the IRS saying, "Hey, we're trying to figure out if this would work. What if we do this?" Insert what I just said. What if we do this? Would the IRS see that as a problem? Would the IRS still give us the step up in basis? What would the IRS do? And so there's lots of these questions that the IRS actually get, and they respond to some of them with opinion letters if they think it's a valuable opinion that should be known. If it's a situation where they're looking at statutes and they're saying, "Oh my gosh, it's not very clear. This may be a loophole because we weren't very clear." And they write these opinion letters so that it is clear. And there have been opinion letters on that technique. So the IRS said that would be, you would get it a step up in basis. And so we're hearing that this is okay to do. This is not a loophole. This is something that's authorized by the code.
Yeah. Well, it
It's
sounds
just,
like
yeah,
that
it's
goes to show you why
advanced,
you
so
need
you don't
professionals.
hear about it a lot.
Right, but it shows you why you need professionals like you to be guiding people because I mean that's not intuitive, let's just say
Well,
that you
for
could
sure,
have
not
that
intuitive
option.
at all. Yeah, you're
Yeah.
right.
And so again, going along the lines of working with seniors, when a family, let's say a family is getting, let's say it's a solo age or just keep it simple, is getting older and says, you know what, before I die, I want to just give this house to my kids. No trust, no nothing. What does that do? What happens when they do that? Just deed it over to somebody else.
They 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 send the cost basis with that deed, and
Right.
so the child then is receiving it's what we call carryover basis, and they just have the property with the same basis that their parent had, which isn't
Right.
helpful because the parent passes away, they still have that property, and when they go and sell it, they're going to have a larger gain and a bigger tax.
Right.
So all that
So as though
achieves
they
is
had bought it themselves 50 years
correct.
ago. It doesn't help them and then you basically take away your ability to do the step up in basis when the
That's
parent passes away.
that's right. That's right.
Yeah. Yeah.
It
We see
seems really
that
nice and
sometimes
easy.
people doing
Yeah,
things. Yeah.
it's easy. It's we out in California we call them quit claim deeds. Um, some people refer to them as quick claim deeds. They hear it and they don't see the word written. So, oh, I heard there's a
Right.
quick claim deed because it's very fast. You can
It's
do that
quick.
very
Yeah.
quickly, and so it
Right.
does kind of make sense. But with any haste, oftentimes there's waste. So, well, it's an easy process. Anyone can go down to a county recorder's office and record a deed, but they're not appreciating the consequences that follow that action.
Right. Yeah, and I think it's just so important for people to engage before they do anything with transferring a property, with deciding to sell it, deciding to rent it. Maybe renting doesn't make sense. There's so many considerations, and I think taxes are one that oftentimes gets overlooked because let's be honest, it's not sexy to talk about taxes, right? It's just not. But it's really important. It's also not sexy to lose $1 million in taxes that you didn't need to lose. That's
That's right.
far less appealing. Um, but so I'm big on collaboration between different types of professionals. So let's say if a family is thinking about selling that home, what would good collaboration look like? Who should they be collaborating with before that family makes that decision?
Well, I think you have to start with the CPA and understand what the taxes are going to look like. And really, they're the only ones that are truly privy to the overall sort of portfolio and whatever investments they may have and tax consequences, because, like I mentioned earlier, potential carry forward losses. I mean, there's a variety of reasons. Again, as I mentioned, maybe somebody wouldn't even be eligible to do a 1031 exchange or wouldn't benefit from a 1031 exchange. But when we're talking about somebody's primary as a senior, again, I think you have to know, look, there are reasons people pull assets away from that senior, right? Like they may try to shed some assets as it relates to ultimately the estate tax, and maybe they're trying to get them into some assisted living or whatever, where they're going to qualify if they don't have the assets, they don't have the income. I mean, there are people that are doing different strategies around that. So there are other things that pull in the overall picture, but I think without starting with the CPA and understanding what the tax looks like, because again, if it's a primary and if it's going to be under the Section 121 exclusion, then what are we talking about? Go ahead and sell it. There's not a tax issue, right? So you have to have these conversations. Um, the worst situation you can have is, well, one, like your situation, they went ahead and sold it and paid tax.
Mhm.
Unfortunately, the other I see in the 1031 exchange world is people are sort of familiar with it or have heard of it or learn of it, and they call me, and it's truly an investment property. They call me, but they've already sold the asset, and they think they can still do an exchange. And I've been
Right.
doing this for over 20 years, and I still get one of those calls at least once a month. So that's a situation where between the real estate agent, the attorney, assuming there was an attorney involved, you know,
You
escrow.
you can pull the lender into that. Lenders should know better too.
Well, but the lender's not really involved, at least in, well, there may have been a lender as it relates to the buyer purchasing from the seller, but
Right. Yeah,
you
that's
know,
true. If they're selling, you're right.
you're
You're right.
probably not overly involved. So if that's really the worst of the worst with me with investment property, because again, we talked earlier about that notion of the exchange. It's very different than having a sale and then an acquisition. It is has to be structured as an exchange in advance of that sale, and that's the role that I perform. So a qualified intermediary is a function that a client's own attorney or accountant or realtor is not permitted to perform. So I have to be engaged and work with that CPA or the attorney, financial advisor in advance of the sale of an investment property. And, I'll oftentimes get calls, even when it's a primary. People ask, what can I do to make this work? Because my gain is so much larger than the 121 exclusion.
Right. Kevin, you have anything to add to that?
Yeah, I think that I'll agree with everything that Eric said, particularly with starting with the CPA. If there sometimes there's not a CPA or an accountant, they maybe have they file their own taxes, or they just have a enrolled agent or some document preparer, so that might not be a person that they can really confide in to get some good advice. Where I sit, what I instruct realtors to do, placement advisors in particular, is that if there's going to be a sale of a home, that you should have your clients or whoever has agency. So sometimes it's the senior lacks capacity and it's adult child or some other person that is operating on a power of attorney or as the successor trustee, that they consult with an elder law attorney in particular. And that there's other considerations outside of the capital gains, but that is part of the conversation. Is that an elder law attorney could look at everything full scope, and look at capital gains situations. California, we have property tax issues to look at, whether or not there are some Medicaid or VA benefits issues that could be averted, problems that could be averted for the same reason the capital gains are a problem if you sell property without consulting with experts. You could be walking into problems you didn't even really know existed. And I get those calls as well, where somebody has already sold the property and now they're asking about some particular benefit that their parent might be eligible for, but they're not anymore because the property was sold and they didn't realize that. And they have that, what Eric was saying, that the unfortunate conversation of, oh, well, now that 1031 opportunity, you don't have that because we had the conversation too late, or now you don't have that VA benefit, or you're disqualified for Medicaid. You don't get the step up, or all those things fall into it because people are unaware. So those that are closest to the senior at the time, of course, their family. But professionally, we have fiduciaries, we have placement advisors, we have those that are in home care, that they're really connected with the senior in the situation that, and they're hearing, because they're boots on the ground, they're hearing rumblings of maybe selling the house, that these are times in which they can make a referral to a CPA, to an attorney like me or Eric.
Yeah, absolutely. I came across it once where a client was on Medicaid and was thinking about taking out a loan to raise some capital to pay for whatever. And through a conversation with an estate attorney in New York, it was confirmed that had she taken out that loan, she would have been no longer eligible for the health benefits. So
Mhm.
that would have been worse than not having the money from the loan. So obviously we canceled that
Yeah.
application, fortunately in time, because we you know, ask deeper questions. I think that's the really critical piece here is you have to explore some of these things because seniors might not offer up what they've done with the property or what plans they've done or what conversations they've had. I think it's up to us as professionals to ask, to probe a little bit, even when it's not our area of expertise, you know?
Mhm.
Because if you look at the story that I told earlier about the 97-year-old in Orange County, the cost of her care probably would have been a lot less than the $1 million that she paid to the IRS. So the family's thinking, oh, we're going to have all this money to pay for her care, but they actually paid more to the IRS than they probably paid for her care. So that's the kind of stuff that we want to avoid. That's what inspired me to do this session and, and really talk about this issue a lot because I think there's, tax code is complicated, especially for people that don't do it for a living. There's a lot of terms that they don't understand and it's seemingly very difficult to understand, but when you don't ask the right questions you can end up with some serious implications and missteps that you try to backtrack on you can't. I was in a presentation where I was talking about this issue and there happened to be an IRS attorney in the audience and I asked him, how many times have you seen the IRS return a check?
Hmm.
Because somebody made a bad decision, and he, of
Yeah.
course, was laughing because that never happens, right? Once you take that action, you can't undo it. So that's why it's so important to collaborate with all the right people, the accountant, the attorneys, the 1031 people. Maybe there's a financing strategy that would work better than selling. And if you're an agent, maybe it's just the timing at which you sell. Maybe you're not necessarily turning away a listing, but maybe you're telling the family, you know what, don't sell it right now. Dad's pretty sick. He might not be around. Let's talk to an accountant about when the right time would be to sell. And I guarantee you will win that client over a million times over if you're the one that advises them on that when everyone else is telling them, oh yeah, sell the property, sell the property.
Well, and
That
Mark, even just
yeah.
from a selfish perspective on the broker side, they have the ability to earn two commissions if they're doing a 1031, for example. So if they're just patient, lease it out for a few
There you
years,
go.
earn a little rental commission, ultimately sell it if it's going to be part of an exchange, earn a commission when it's sold. And of course, they have a highly motivated buyer to acquire replacement property, assuming that, they're going to just buy something else in and around the area. So if nothing else, yeah, a little patience will pay dividends.
Yeah, absolutely. You're speaking my language now, Eric. You know, Eric's done all of my own personal 1031, so he and I have worked together quite a bit. So, and all these things are important, you know. You gotta understand the rules that you're playing by, because you're playing by those rules whether you know it or not. So you're bound by them no matter what happens. So all right, Eric and Kevin, thank you guys for wrapping up the day today. I know this is a tough topic. But I appreciate your insights, and I think hopefully the audience has gotten something about this. About, again, the goal here is not for everyone to be an expert on capital gains tax, but really to just know when to raise a flag and say, talk with a professional. You know, hopefully you have people in your network that can help find the right person who can guide the family through those decisions, so that they don't make a mistake that they can't undo. So I appreciate your insight. I think we've done good. For the audience, and hopefully people learned something new today, and you know, the world's a better place for our conversation. So
Yeah. Yes.
Thanks
Always
for
happy to
having
be a
us.
resource.
we're
Thanks
saving
so much.
lives here.
Thanks,
All right,
Kevin.
guys.
Thanks,
Thank
Mark.
you all so much. Thanks for joining. We're gonna have a quick closing session here in a couple minutes, and then we're done for the day. So thank you so much, and see you all soon.